In this week's video, we'll cover numerous scary stock charts that speak for themselves. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This tweet from February 2nd sums up where we are as of Friday, February 5th. This Friday here, a week ago, is when the S&P 500 rallied 46 points, and last week we said for our time frame that was basically a counter-trend rally, most likely, and volatility to ignore. This tweet still applies. Not much has changed on our time horizon since last week. The trends were weak a week ago, and they're still weak today. That doesn't really tell us anything about what will happen next week other than the probabilities are unfavorable. From a chart perspective, we'll kick off the video with a weekly Wilshire 5000 chart. This is about as broad as you can get. In theory, the S&P 500 has 500 stocks. The Wilshire 5000 has 10 times more than that, and is a much better gauge of the broader stock market. This, if you're familiar with technical analysis, may be a topping pattern from a probability perspective. It's known as a head and shoulders. Here is the left shoulder, here's your head, and here's your right shoulder, and here's your upward sloping neckline here. You can somewhat think of this as early adopter sellers that may see the economy is starting to wane, and then more people start to see the problems, and then the last shakeout occurs here. And when you break the neckline from a probabilistic perspective, you can forecast where prices may go. We take the distance from the top here to where it runs into the neckline, and then we project from where the breakout or breakdown occurred. In this case, relative to the close on Friday, February 5th, if the probabilistic projection turned out to be where we're headed, this index would lose an additional 11.34% from the close on February 5th. Regular viewers and clients know we're not in the forecasting business, but it is good to understand that this is an unfavorable risk-reward profile. We also had a market that for the most part broke down here. This was support, support, support. It broke down. This is a normal retest of the area. Support, support. What once acted as support may now act as resistance. We came up and were rejected at a logical area, and now we're closing below the neckline. What does this mean, and how should we use this? The situation we find ourselves in here is very, very similar to a tornado watch relative to a tornado warning. We're really on a plunge watch here, which means conditions are favorable for a plunge. It doesn't mean a plunge is imminent. It's different. If things start to deteriorate further, we may move into a warning, but right now we're probably under just a plunge watch. But even that tells us that the probabilities aren't very favorable. So for example, if you knew there was a tornado watch in your area and you really didn't have a reason to leave the house, you probably would stay in the house. Even under a watch condition, it speaks to probabilities. Right now, those probabilities are unfavorable from a risk-reward perspective. The CCM market model looks at the weight of the evidence, and the same concept will apply to these charts. We're seeing very, very similar things. Global stocks, it's even worse because the neckline is sloping downward. This looks like a breakdown here and then a normal retest of that breakdown. And in this case, that's a successful retest because what once was support now acted as resistance. The probabilities would improve for the bulls if we could move back above the neckline, which may or may not happen. This week we closed well below the neckline. When we draw manual trend lines on charts or necklines, it's somewhat of an arbitrary process. It's not an exact science. Some of these charts are below necklines. Some of them are remaining above the neckline, which is one of the reasons why on Friday we somewhat went halfway. We had 4 moves we could have made. We only made 2 of them. This is one of the reasons why we didn't make all 4. In this case, your downward sloping neckline on the NYSE Composite weekly, we closed above it, giving us some hope for a bounce and bullish outcomes. A logical question might be, well, Chris, if we closed above the neckline, then why did you make 2 additional chess moves that were somewhat defensive in nature on Friday? Well, we have a mixed bag. That was a high-low close chart. This is closing prices only, and this is a scary looking chart because the projection says we could lose an additional 7.88%, and these projections, like the neckline, are far from an exact science. S&P 500 daily, this is 2014, 2015, early 2016 here as of the close on Friday, February 5th. Support, support, support. We broke support. To be determined in this area. We really can't decide what we want to do. Last week we closed above this line. This week we closed below it, which also speaks to deteriorating probabilities. What once was support may now act as resistance. We came back up and reversed at a logical level. Notice how many charts have somewhat of a left shoulder ahead and a right shoulder look. This is the S&P 500 weekly, same concepts. Support, support, we broke it. Looks like a retest here. What once was support may now act as resistance. Price was rejected. If this is a neckline, and that's to be determined, price will determine that. In this case, the projection would take you down to the 1700s on the S&P 500 index. On Friday, February 5th, we closed at 1880. Same exact concepts. This is S&P 500 weekly high-low close. Closed below this line here this week. If you use the hypothetical projection, it projects an additional loss potentially and hypothetically of 13.56%. That's an additional loss from the close on Friday, February 5th. The market model also follows numerous risk-on versus risk-off ratios. This is 2013 here. This is stocks relative to bonds daily. Support, 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 support. Very indecisive in this area. Last week we closed above these lines. This week we reversed and closed below. The longer we stay below these lines here, the more concerning it becomes, and the odds are more unfavorable below the line, and that's where we closed on Friday, February 5th. Is it possible on all of these charts that we will move in this direction? Absolutely, positively, yes. I can find cases in history where you have topping patterns like this and stocks rallied strongly. Given the weight of the evidence that we have in hand, the odds seem to favor a drop in this direction. But let's assume I put those odds at 90%. That means there's a 10% chance that the market rallies, and this is not a head and shoulders pattern. And the whole idea of probabilities speaks to the fact that the lower probability outcome can occur, and we have to be open to improving evidence. As always, price will be our guide. Is it all gloom and doom from a support perspective? No, this chart here, stocks versus bonds using closing prices, we closed above support, telling us there is still some reason to be hopeful for a move in this direction. Like all of the charts, price will guide us. The probabilities will drop if we move into this area here. A fair question maybe, but isn't it energy that's dragging everything down? Well, if we look at an equal weight S&P 500 index, we have a very, very similar situation. Breakdown looks like a retest. What once was support now acted as resistance. If we're below this line, this chart takes on that scary look from a probability perspective. Regular viewers and clients know that we've covered the V-bottom situation here. You can make an argument that those V-bottoms in this period here were caused by the Fed stepping in. Every single time the market started to pull back, it seemed that a Fed governor said something to prop the market up. You can argue that this is an artificial move here, boosted by the Fed. You could also make an argument, now that the Fed is stepping back, that we could retrace all of this artificial V-bottom move. We seem to be doing some of that now. This is a different setup here, but it's also scary from a probability perspective. I can draw a support line here. You can see when we break down below and we get a plunge look, sometimes bad things happen. Support here, plunge type look, bad things happen for a time. Support, support. That is not a particularly confidence-inspiring slope right there, and it's below support. It's possible that we get a look like this next week. It's also possible that we get a bounce next week. There are fundamental reasons why the general market has become somewhat obsessed with oil, and some of it's tied to the credit markets. If I borrowed money in the past to build, let's say, an oil well, that contract in terms of rolling over the debt might be based on a certain price per barrel. For oil, let's say hypothetically, a lot of those are tied to $30 a barrel. So when we start to drop below that level, it can affect rolling over debt, and it can affect financing, and it can affect potentially interest paid on that debt. This chart says it's possible, if we stay in this trend channel, that oil still has further to fall, and like everything else, this just speaks to odds. Nothing says oil has to stay in this trend channel here, but often something as simple as an angle proves to be very helpful in technical analysis. Viewers may recall that on January 15th, we used the 50-day and the 200-day to show that we can use moving averages and hard data to help us discern between volatility to ignore and volatility to respect. And we said this is a negative look here. Here are the same moving averages today. When we just remove noisy and distracting price, it's easier to discern the trends. This is the 35-point loss day on Friday, February 5th. Notice how it helps us filter out the noise. This is on the day where we have a 1.85% drop in the S&P 500. It's pretty easy to see that the trends don't look very good. Let's compare and contrast that to the look of the exact same moving averages and the trends on a massive up day. This is the same chart a week earlier, January 29th. This time, instead of being down big, the chart or the market is up big. We were up 46, almost 47 points on January 29th. And you'll notice the two charts really don't look that much different, telling us that these types of charts and techniques help us filter out that distracting day-to-day noise that causes an incredible amount of stress. We've shown plenty of glass half empty charts. Let's show a glass half full chart. S&P 500 daily as of the close on Friday, February 5th. We still have not taken out 1867, and as long as these levels hold, there is some basis for hope from a bullish perspective, although there is a lot of potential resistance overhead. Here's a glass half empty version of the daily chart using closing prices, support, what once was support may now act as resistance. Here's a breakdown of what looks like a retest. On January 22nd, we talked about monthly stock signals that were hard to ignore. Let's just update that. Here's the same monthly chart with the same monthly moving averages as of the close on Friday, February 5th. We'll close the video by keeping clients and regular viewers updated on our weekly charts. This is a full bore bearish look from a probability perspective, 2008 full bore bullish look. Thankfully, the model helped us classify on our time frame the big move last week as a counter trend rally and volatility to ignore. This week, the S&P 500 lost 60 points, or over 3%. We closed with a full bore bearish look, and Monday will be a new day. We like to put our capital in harm's way when the odds are in our favor. This is a favorable look from an odds perspective. We like to move our capital out of harm's way when the odds become unfavorable. We really don't want to see a look like this. Every single chess move, and we've talked about them all on Twitter that we've made since early December, has been defensive in nature. Why? Because you can see that the data and the observable evidence is deteriorating here. We closed on Friday, February 5th with a full bore bearish look using these longer duration moving averages. Since there's no perfect way to monitor risk in the financial markets, the CCM market model is highly diversified. This is we prefer to have our capital out of harm's way look. This is a favorable look. In last week's video, we said this looks like a counter trend rally, and on our time frame, it was volatility to ignore. This week, the downtrend continued. The NASDAQ over the last 5 sessions lost 5.44%. Same concepts using a ratio, risk on versus risk off. After a counter trend move, a normal counter trend move on the weekly chart, this ratio fell 4.35%, telling us that TLT beat the S&P 500 by over 4% over the last 5 trading sessions. We covered these charts in detail last week. These are the credit markets. This is a weekly we're concerned about defaults look. This is a look that says we're not really concerned about defaults and we'd prefer to chase yield. Last week we said we'd get a similar look if we plugged in JNK. So this week that's exactly what we did. We still have a we're concerned about defaults look in early 2016. Ugly charts can begin to improve at any time, which means we're not forecasting here. We have to be open to that improvement, and the only way we can do that is to maintain maximum flexibility. Since the stock market's profile was unfavorable a week ago, and it remains unfavorable a week later as of Friday, February 5th, all of these videos still apply. We have not seen anything that changes the idea that it's prudent to check your bear market game plan, as we covered on January 8th. Bear market risks increasing at rapid rate, covered on January 15th. Monthly stock signals similar to 2001 and 2008, covered on January 22nd, still in place. And our concerns about the Fed being out of bullets is also something that's still relevant and may be relevant now, or it may be relevant in the future. If you have not seen these videos, you can find them on the Shivako Capital channel by Googling Shivako Capital channel. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog, Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.